Welcome to another episode of China Update, where I provide you with the most up-to-date political, economic, and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Happy Wednesday, everybody. Let's begin with the economy. I'm still working through the new trade data for the month of August, released yesterday, and talking to contacts. We will cover that in tomorrow's video. My apologies for being a little slow with this. First up, though, we need to discuss the stock market, perhaps one of the most illustrative signs of just how poor confidence is in the economy, both domestically and globally. Chinese equities trail global ones for a fourth year running, with the CSI, China Securities Index 300 Index, near its lowest level since January 2019. Down almost 7% this year, the CSI 300 Index is staring at an unprecedented fourth annual drop, while the MSCI Inc. gauge of Chinese stocks is headed for its longest stretch of underperformance versus global equities in over 20 years. US-based Bloomberg reports that selling pressure is mounting as China's property crisis drags down consumer spending and geopolitical tensions simmer before US elections in November. The risk for Beijing is that the market slump further erodes confidence among consumers and businesses, spurring the very deflationary feedback loop we have been following in recent months, and which we will cover more later in today's video. Ron Temple, chief market strategist at Lazard Asset Management, said in a Monday interview, quote, "It's been an amazingly bad period for markets. The problem is the economy is in a worse place than I thought 6 months ago. The longer the government refuses to create any major demand stimulus, the longer the consumer confidence damage will persist, and the harder it will be to resolve." End quote. As Bloomberg economists explain in a note, quote, "It's not that policymakers haven't acted to fix the problems. Just this year, state funds are estimated to have purchased around $66 billion worth of exchange-traded funds to prop up stocks through mid-August. We covered that at the time. Restrictions have been tightened over quant trading and short selling in a bid to reduce volatility, while companies are urged to boost buybacks and dividend payouts. In February, China replaced the head of the securities regulator in a surprise move. For investors, however, the measures have been underwhelming, and China doesn't seem willing to pursue a different economic track that will empower businesses. The risk is that the stock market will be stuck in a limbo as China enters an era of slow growth, lacking the vigor of an emerging market and the stability of a developed one." End quote. China's underwhelming market performance stands in sharp contrast to the bullish global stock trends this year, highlighting investors' skepticism towards Xi's economic vision. The CSI 300 index has fallen to levels seen in early 2019, while stock benchmarks in the US, Japan, and India have nearly or more than doubled during the same period. The tightening of state control over private businesses and escalating trade tensions as China pushes for industrial self-sufficiency are key factors that have made Chinese stocks unappealing to many investors. Since its peak in 2021, approximately $6.5 trillion has been erased from the market value of Chinese and Hong Kong stocks, a figure nearly equivalent to the entire Japanese equity market. Stephen Long, executive director at UOB Kay Hian Hong Kong Limited, speaking to US media this week, expressed, quote, "The China and Hong Kong investors I know are so disappointed. They are cutting down their already low exposure, feeling hopeless. Quantitative easing type government liquidity is the only way out." End quote. Next up, yesterday, Tuesday, speaking with a group of journalists after a meeting with European Union and NATO counterparts in Brussels, US Deputy Secretary of State Kurt Campbell expanded the US government's description of PRC support for Russia, saying that there is a, quote, "very substantial effort on the part of China to help sustain, build, and diversify various elements of the Russian war machine," end quote. He also said that Moscow is in return now sharing more sensitive defense technology with the PRC, including in, quote, "submarine operations, activities of aeronautical design, including stealth and missiles," end quote. Historically, Moscow has been very wary of giving Beijing, traditionally a security competitor, its very latest military technology. The US previously focused on Beijing's supply of what are known as dual-use technologies, which can be applied for military or civilian purposes. Campbell told the journalists, quote, "These are not dual-use capabilities. These are basically being applied directly to the Russian war machine. These are component pieces of a very substantial effort on the part of China to help sustain, build and diversify the Russian war machine. We're seeing efforts at the highest levels of both governments to try to both hide and protect certain elements of this worrisome collaboration. Most of these activities have been driven underground." End quote. Later in the comments he expressed, quote, "The capabilities that Russia is providing is support in areas where previously they had been frankly reluctant to engage directly with China. We are concerned about a particular number of military arenas where there appears to be some determination to provide China with greater support." End quote. It is unclear why the US is making this position public now, nor what the US and NATO will or can do about it. UK-based Reuters writes today that US National Security Advisor Jake Sullivan has repeatedly raised concerns with China's foreign minister and top diplomat Wang Yi about Beijing helping Russia in back-channel meetings that the two officials have had over the past year. But the US is also asking Europe to take more action, including sanctions, to put pressure on China to dial back its support. Alexander Gabuev, director of the Carnegie Russia Eurasian Center in Berlin, explains that Moscow has become more willing to collaborate with Beijing on military technology after its annexation of Crimea in 2014, and the process had accelerated since its full-scale invasion of Ukraine in 2022. Expressing, quote, "Russia realized that China is pumping tens of billions of dollars into defense research and production annually. Russia realized that in certain limited areas where Russia still has superiority, it has a window of opportunity right now to grow into the Chinese market, earn money, and, in the best-case scenario, join a joint value chain." End quote. Next up, we move back to the Chinese economy, but just quickly, if you're getting some value from today's episode, don't forget to hit the like button. If you like China Update generally and you like to see the channel grow and be shown to new people, I have a huge favor to ask. That is to subscribe if you have not done so already. Hit the bell notification so you're on top of the most up-to-date analysis. And if you know someone who would like this sort of content, sharing it is also a tremendous help. Patreon and Buy Me a Coffee links are also in the description for those who want to help keep the channel financially sustainable. Thank you so much, everyone, for the ongoing support. Next up, over the last several days, we've been following the growing chorus of voices in China and around the world, deeply concerned about the country falling into a dangerous deflationary trap, including critically the former head of China's central bank over the weekend. In light of a prolonged property downturn, economic damage done by years of zero COVID, geopolitical headwinds, creeping statist and central planned policy, and a tanking stock market, households have cut back on spending and increased savings, with the seasonally adjusted household savings rate in the second quarter at about 31%, according to a recent Goldman Sachs report. Beijing has responded to weak consumer confidence by pumping loans into the industrial sector, relying on manufacturing and exports to keep the economy going, while property grinds through a huge oversupply of unsold homes. But this has also increased the supply of consumer goods at a time of low demand, worsening deflation. China's producer price index has been in deflationary territory for the past 23 months. There are two new pieces from the last 24 hours which I wanted to briefly cover here. This should supplement our coverage from the past few days. First, UK-based The Financial Times reports that several investment bank economists are calling for stimulus packages of up to 10 trillion RMB, $1.4 trillion US dollars, over 2 years in stimulus funds to reinflate its economy and return it to sustainable growth as concerns grow that deflationary pressures are becoming too entrenched. The stimulus, which would be 2.5 times the size of the so-called bazooka package China enacted after the global financial crisis in 2008, would need to directly target households through social welfare spending rather than investment in infrastructure, the economists argue, adding that the matter was becoming more urgent. The more embedded deflation became, the more it would cost to dispel it through stimulus measures. Robert Xing, chief China economist at Morgan Stanley, argues, for example, quote, "The longer that deflation stays, the bigger the ask in terms of reflation." End quote. He says that in a bull case, Beijing could issue 10 trillion RMB in stimulus funds over 2 years, 7 trillion to boost social welfare spending, For China's 250 million so-called migrant workers who are undercovered by existing pension and healthcare systems, the other 3 trillion would be used to accelerate the sale of China's massive housing inventory and more quickly stabilize property prices. He calculated that this would require an annual increase in China's augmented budget deficit, which includes all levels of government spending, from 11%, which is already quite a sizable deficit, to 14% of GDP. In yesterday's video, we examined a piece by Michael Pettis at Peking University on why such an expensive policy move is difficult and unsustainable. If you haven't seen that and are interested in the space, it is worth a watch. Indeed, on this Financial Times piece that we're now discussing, Professor Pettis observed today, quote, "There is now almost universal consensus among Chinese and foreign analysts that to keep growth high, the Chinese economy needs a major fiscal stimulus aimed at boosting consumption. But while it will help in the near term, a fiscal stimulus is only a temporary solution. It will probably take another 2 to 5 years before a consensus develops on why this will prove so difficult to pull off sustainably." End quote. The Financial Times writes that Hui Shan, chief China economist at Goldman Sachs, said that China will need about 3 trillion RMB to stabilize the property market and another 1 trillion RMB for cash-strapped local governments. Quote, "You need to give people the confidence that the government is helping the people, not only building more infrastructure or just following the old stimulus playbook. So you need about 5 trillion RMB just to have a meaningful impact." End quote. Chris Bedore, Deputy Director of China Research at Gevical, estimated that China needed between 3 trillion and 8 trillion RMB in direct transfers to households to, quote, "return household consumption to the pre-pandemic trend." End quote. Harry Hu, chief China economist at Macquarie, said that 5 trillion to 10 trillion yuan would be, quote, "reasonable," end quote, in terms of what is needed to reinflate the economy. Fred Newman, chief Asia economist at HSBC, told the Financial Times that 5 trillion RMB would be a baseline number for stabilizing prices, expressing, quote, "There is a phenomenon here where there's been a lack of confidence. This very high household savings rate, for example. People do not want to spend. So it's really about bringing confidence back rather than necessarily the size of the package," end quote. He added that China has announced a series of smaller confidence-boosting measures, such as consumer trade-in schemes and industrial equipment upgrades to boost consumption, but incremental measures often lost their impact. Quote, "So that's why shock and awe is sometimes the right approach. There's a risk that we've been so incremental over the past 18 months that every announcement doesn't rebuild the confidence that we need." End quote. The second piece we will cover on this area of concern around deflation is from Paul Podolsky, founder of Kate Capital LLC, called Downdraft from his Substack. We will end today's video by quoting selected excerpts from the piece directly. "China is in a deleveraging and needs appropriate easing and is not getting it. Deleveraging matters because it forces a series of changes in other asset prices that impact us all and are now evident in China and maybe globally. A deleveraging is a process of reducing aggregate debt. An economy is a series of interlocking relationships. This is what's so complicated about understanding the economy and why even great investors can at best have a partial understanding of this many variables that make up the financial system. That said, borrowing is spending tomorrow's money today. The problems begin when tomorrow ends up looking very different than what we thought it would look like. Then you owe a huge amount of cash to service the debt, but suddenly there is not enough. This is what happened in the US in 1929 and 2008, and Japan in 1990, and what is happening now in China. China built a huge amount of real estate based on an estimate of economic growth that would generate the cash to pay off that investment. But the growth is not there to support the cash flows, and so growth goes in reverse. The only known solution to this problem, print, is the one that seems counterintuitive to many people but makes logical sense. It is also what ended the Great Depression, got us through 2008, and ended Japan's lost decades. The issue is that if one person cuts spending to repay their debt, that is responsible behavior. If everyone reduces debt at once, it is a depression. Debts in China are far greater than income.
which means as people pull back en masse, total income shrinks. Printing boosts aggregate incomes, short-circuiting this doom loop. The central bank is the only entity that can perform this function. In fact, it's why they exist. While I know quite a few investors who are buying Chinese stocks because they are cheap, the PE is about half less than the US, I am not touching them. The companies are selling into a shrinking economic pie. Here ends the direct quote in today's episode of China Update. Let me know what you think about some of these developments from today, including this last piece, but also the earlier pieces on the stock market and the US comments on the China-Russia relationship. Thank you for watching today's episode. Have a wonderful Wednesday, and I will see you all tomorrow.